Hello and welcome to this Markets Today special. I'm Udayan Mukherjee. With me is Abha Bakaya, and our guest today on the show is a successful fund manager, mutual fund manager with a very strong track record, Rajiv Thakkar, CIO and Director of PPFAS Fund Management. Rajiv, great to have you on the show. I want to start by asking you a little bit about global investing as well, because you were one of the early mutual fund houses which offered investors the choice of owning international stocks as well. I mean, you had a strong domestic portfolio, but with some of the large technology names. How is that proposition doing now in the light of the fact that the Nasdaq's gone through such a significant correction over the last few months?
Thanks for having me, Udayan. Obviously, last 1 year has been tough given the big fall in the US tech stocks more specifically, and overall the US markets. Indian markets are close to all-time highs, whereas US markets are or US stocks are anywhere down between 25 to 40% in that range broadly. So last 1 year has been tough, but if we look at it over, let's say, a 3 years kind of cycle, one of the schemes that invests only in India and the FlexiCap fund, which is India plus US kind of mix, both are at very similar return levels. So not much of a difference in that sense.
Right. Now, my question is not so much about the past, but it's about the future, because, till about a year back when the Nasdaq was doing so well, a lot of Indian investors wanted to be in the Nasdaq and in the US techs. But now that faith has been shaken after the performance of the last 1 year. As you look at some of your big holdings in that space, do you feel that some of this technology pain has already played out and the coming 2-3 years could be good again? Or have you jiggled your portfolio around as well to reduce some of those weightages?
Sure. So I think people who invested in this space looking at past returns and expected quick returns have been disappointed very clearly. But that was probably not the right way to look at this space. If we look at the underlying trends, which have been playing out for a very long time and which are expected to play out over the next decade as well, in my opinion, those are intact. So if we look at the habits of people or the trend shifts, people are preferring streaming media content versus linear TV. People are preferring e-commerce versus physical retail. People are going towards cloud computing instead of on-premise servers. Digital advertising is the preferred medium over traditional advertising. So I don't think there's anything wrong with the underlying trends that have played out in the past and that are continuing to play out in the future. Sure, stock prices have come down a bit. There is increased focus on profitability. There is focus on cost controls and things like that. And some of the side projects have not been looked at kindly by the markets. But these are very, very strong companies. Most of them are either monopolies or duopolies in their area of operation. And the valuations are not demanding at all. So these are somewhere around 20 times earnings, or in some cases barely double-digit price to earning multiples. So it's not that these are very expensive or these are zero growth companies or anything like that. So we are quite positive on this space going forward as well.
But what about locally, Rajiv? Because you spoke about these digital trends. They are true of India as well as they are of the US. But here, investors seem to have given a very wide berth to these digital stocks. And there is, you know the Zomatos and even the Nykas of the world these days. As a fund manager, how have you looked at Indian digital stocks compared to the US ones?
Sure, Udayan. So that's a very interesting point that you're making. And I would like to differentiate the tech space into two buckets. In one bucket, I would put companies where people see a future promise in terms of growing market share or lifetime value of a customer, but current reported earnings are either in losses or barely break even, and sales growth is typically higher. So in this space, to an extent, there is a dependence on raising fresh capital from investors, either in the private space or in the public listed markets. And that funding environment has gotten very tough over the last year or so. And this will be a moment of truth in the coming year or so, where these companies will have to quickly pivot towards showing profitability, or at least eliminating cash burn and having clarity on the path to profitability. The space where we are invested in are, I would call, somewhat mature tech space, where they have been around for a couple of decades or more, where you can value them on a conventional basis in terms of the cash flows that they are generating, or in terms of the revenue that they have and things like that. So I think the companies that we own, which are the Microsoft, Alphabet, Facebooks of the world, are very, very different from, let's say, a Zomato or from a Nykaa. You have these kind of companies in the US as well. So you have things like DoorDash, etc. in the US, or Grubhub and those kind of companies. But we have stayed away from loss-making companies, or companies which have a lot of cash burn, because we are not clear on what the future will look like. We are more positioned towards slightly more mature businesses.
Rajiv, how are you looking at your overall strategy right now? You know, given of course the context you've just described, of course, but would you be also adding on other pockets of the market where you see opportunity? What would be the overall balance? How are you looking at things currently?
So in the overall market, we are close to all-time highs. So it's not a cheap market in that sense. It's not a market where you can be buying indiscriminately or holding on to stocks regardless of valuations. The way I see it is that the consumption-oriented space, which has been a favorite of the markets, has been taking somewhat of a breather, given that valuations have become very, very excessive, and even where profit growth is there to some extent, the valuation does not leave any comfort for stock prices to increase. At the same time, very interestingly, a space that has been a laggard for I don't know how long, maybe a decade and a half or thereabouts, which is the PSU space, is seeing some revival of interest. So some of the tough privatization decisions are starting to be made. Air India, for example, has been privatized, and some bank mergers have been done. LIC listing happened, and there is talk of privatization of some more companies. So here we are seeing a rebound from very, very low level of stock prices and valuation, where cash flow yields are very, very high, and people are selectively looking at this space. Also BFSI space, especially the private sector banks, have had a very good run in terms of the numbers that they have reported. Balance sheets are clean, the credit costs are muted, credit growth is back, and spreads should increase given that rates are rising, and their current account, saving accounts are low cost deposit basis. So broadly in the market, there are pockets which are overvalued. We are staying away from those, and we are trying to find attractive purchases in the undervalued space.
You spoke about BFSI, Rajiv. So let me ask you how you're approaching this space as a fund manager. Let's keep the private banks aside, because most people seem to agree that they are strong franchises. But between the two other pockets, which is public sector banks and NBFCs, which one would you plump towards right now?
So we are veering towards a third bucket, which typically does not find mention in BFSI discussion, which is the services related businesses in the BFSI space. So we own a depository, we own a commodity exchange, we own a power exchange, we own a stockbroker stroke asset manager. So we are looking at companies which are relatively more asset light, where there's not much of a possibility of credit losses, but which participate with the overall growth in the BFSI space. We don't own public sector banks, and neither do we have very strong exposure to NBFCs. We do have an indirect exposure to the Bajaj NBFC group via their holding company, but generally our preference is towards the private sector banks. Second order of preference would be the select NBFCs, and third would be public sector banks.
Now, that's an interesting proposition, Rajiv. So, let me just ask you for slightly greater detail on this. If your preference is for fee-based BFSI candidates and not fund-based, in that space, what would be the pecking order? I mean, because there is something like a CAMS, which is fee-based, something like a CDSL, which you probably own, and you also spoke about something like probably an IEX. What is the most stable business model to be backing in the diversity of options in that space?
Sure. So, in this space, the interesting part is that in most cases, businesses are either dominant monopolies or duopolies in terms of exchanges or some of the depositories and things like that. Also, the business is more or less a fixed cost business where the bulk of the cost is the employee cost and the technology architecture and infrastructure that they run. And as they participate in higher and higher volume growth, be it in terms of number of trades settled or transacted on the platform, or be it more companies getting listed or more transactions happening, more people opening accounts, things like that. So most of the additional revenue tends to flow to the bottom line. So there's no specific preference for one space or the other. We look at each company on its own merits, but that entire fee-based space, which is more technology driven and where it's a monopoly or a duopoly kind of situation, that space looks attractive to us.
Rajiv, in terms of overall how a retail investor should perhaps look at the market, and particularly some of your funds, which as we've been discussing also are fairly tech heavy and include some of those global names, what would you advise at a time like this with volatility expected to continue at least for the next couple of quarters? What's the kind of return potential that you're looking at over the next few months?
So volatility, I would say, is a feature of the equity markets rather than bug. Markets have been volatile almost every time that you see in the past, and in the future I don't think it will be any different. The environment that we are going into is an environment where fixed income rates are at least turning to break even, where interest rates are matching inflation rates, and maybe they will start providing a positive real rate of return. So we haven't seen a neutral to slightly tightening kind of rate environment for quite a while, especially in the developed countries and also in India. So people coming to equity markets, retail investors that you spoke about, should be prepared for the long haul. Don't expect an environment where there will be no volatility or you will get steady year-on-year kind of returns. If someone is prepared to come and invest at least for a 5-year horizon, there is a possibility of earning decent returns. But next 3 months, 6 months, you might as well be staring at somewhat positive returns or negative returns. It could go either ways, given the challenging macroeconomic environment, geopolitics and what have you. So I would strongly advise a longer term investment horizon if people are coming to equities.
Rajiv, good talking to you today and nice to hear your thoughts. Thank you very much for your time.
Thank you for the opportunity.
If you like the video, do like, comment, share and subscribe.